America's national debt has skyrocketed past a jaw-dropping $38 trillion. I mean, that's not just a random number. It's not something you can just brush aside or pretend doesn't matter. It's like a ticking time bomb that could seriously impact our economic future. With every tick of the clock, with every passing day, it grows bigger, casting a huge shadow over our financial stability. And here's the thing. This isn't some distant problem for future generations to worry about. It's happening right now, affecting decisions being made in Washington today, influencing how other countries view our economy and shaping the financial landscape we're all navigating. People are understandably freaking out, asking, is there a way out of this mess? Can we actually navigate this crisis before it spirals out of control? These aren't just worried whispers anymore. These are real conversations happening in boardrooms, on trading floors, and around kitchen tables across America. Well, some folks are looking at both a super modern and a really ancient solution, Bitcoin and gold. Could these assets be the key to reshaping America's financial destiny? Let's dive in and break it down. First off, the national debt isn't just some abstract figure floating around in economic textbooks or financial news tickers. It's not monopoly money. It has real-world consequences that hit us where it hurts. It affects interest rates, the rates you pay on your mortgage or your car loan. It affects inflation, how much your groceries cost, and whether your paycheck actually stretches to the end of the month. And it affects the value of our dollar, both here at home and on the global stage. When you hear about the debt climbing, you're hearing about something that touches every aspect of your financial life. As the debt keeps climbing higher and higher, confidence in our traditional financial system starts to waver. People start to wonder, can the system handle this? Is the dollar as stable as we've always believed? This erosion of confidence is subtle at first, but it can accelerate quickly. This is where alternative assets like gold and Bitcoin come into play. They represent something different, something outside the traditional system. Historically, when the economy takes a nosedive, when things get shaky and uncertain, investors flock to gold. It's the original safe haven asset, a tangible store of value that has preserved wealth for centuries. We're talking thousands of years of human history here. Ancient civilizations valued gold. Medieval kingdoms hoarded gold. Modern central banks still hold massive gold reserves. Think about it. When governments print more money and debt levels skyrocket, gold often shines the brightest. It's almost counterintuitive, right? When everything else is falling apart, this yellow metal that doesn't do much just sitting there becomes incredibly valuable. It acts as a reliable hedge against inflation and currency devaluation. When your dollar buys less, gold typically holds its purchasing power. That's why it's a classic move in the financial playbook. It's been tested through wars, recessions, depressions, and every economic crisis you can name. But now there's a new kid on the block, Bitcoin. Often dubbed digital gold, Bitcoin shares some key characteristics with gold. And the comparison isn't just marketing hype, it's scarce, with a fixed supply of only 21 million coins. That cap is hard-coded into the system. No one can change it. No committee can decide to print more. Which means it's not going to be endlessly printed like paper money. Governments can fire up the printing presses whenever they want. Central banks can expand the money supply with a few keystrokes. But Bitcoin? The supply is set, predictable, and finite. It's decentralized, so no single government or bank can control it. There's no CEO of Bitcoin, no board of directors. No country that can shut it down or manipulate its supply. And here, that's the kicker. It's increasingly viewed as a hedge against the same economic instabilities that make gold attractive. As worries about fiat currency devaluation grow, as people watch governments struggle with massive debt loads and question whether traditional currencies can maintain their value, more and more investors are paying attention. These investors range from everyday folks, people just trying to protect their retirement savings, to big institutions, hedge funds managing billions of dollars, family offices, even corporations putting Bitcoin on their balance sheets. They're diversifying their portfolios by adding Bitcoin. The idea is pretty straightforward. If the traditional system is under strain, if there are cracks in the foundation, it makes sense to have a foothold in an alternative one, right? It's the same logic that's driven people to gold for millennia, now applied to a 21st century digital asset. You don't put all your eggs in one basket, especially when that basket is showing signs of wear. So how could Bitcoin and gold help tackle a mind-boggling $37 trillion problem? And yeah, I know I said 38 trillion earlier. The number keeps going up, which is part of the problem. It's not just about individuals protecting their wealth, though that's certainly important. Some really interesting proposals suggest a more direct, national-level strategy. Picture this. What if the US government created a strategic reserve of Bitcoin similar to how it holds gold reserves? The US has held gold at Fort Knox and other secure locations for decades. It's a strategic asset, something the government can rely on in times of crisis. A report from ARK Invest, a well-known investment management firm that focuses on disruptive innovation, suggests that if the US were to allocate just a small portion of its assets to Bitcoin now, while prices are still relatively low compared to future projections, the growth potential could be massive. They've run the numbers, looked at the models, and their projections are striking. They project that a strategic Bitcoin reserve could potentially cut the US national debt by as much as 35% by the year 2049. That's a game changer. Think about what that means. We're talking about potentially eliminating more than a third of our national debt through the appreciation of a digital asset. That's not a small adjustment. That's not tinkering around the edges. That's a fundamental shift in how we could approach our fiscal challenges. Let's break that down a bit more. Bitcoin's value has seen some incredible growth over the past decade. When Bitcoin first appeared, it was worth pennies, then dollars, then thousands of dollars. Now we're talking tens of thousands per coin. Sure, it can be volatile. We've seen massive price swings, corrections that make traditional investors nervous, crashes that wipe out billions in market value overnight. But the long-term trend has been mostly upward. If you zoom out and look at the big picture, the trajectory is clear. Some analysts are even predicting that Bitcoin could hit $500,000 by 2025. That's not some fringe opinion anymore. Respected financial analysts, people who've built their careers on making accurate market predictions, are putting out these numbers. And there are some super optimistic long-term models out there that see its value climbing into the millions per coin. These models take into account Bitcoin's fixed supply, increasing adoption, institutional investment, and the ongoing concerns about fiat currency devaluation. Just imagine if the US government held a reserve of, say, 1 million Bitcoin. That's less than 5% of all Bitcoin that will ever exist. It's a significant holding, but not impossible to acquire over time through various mechanisms. If the price appreciates as predicted, if Bitcoin follows the trajectory that many analysts believe is possible, the value of that reserve would explode. We're talking about creating a massive asset on the government's balance sheet. Something that could be used to pay down debt, fund programs, or stabilize the economy in times of crisis. One projection even suggests a single Bitcoin could be worth over $42 million in the future. Now that's on the extreme end of the spectrum. It's a very bullish case. But even if the actual number ends up being a fraction of that, we're still talking about astronomical growth. That's a number that could totally change the entire debt conversation. Suddenly, that 37 trillion, 38 trillion, whatever it is by the time you implement this strategy, it starts to look more manageable. But wait, there's more. Beyond just holding Bitcoin as a strategic reserve, there's this cool concept of Bitcoin bonds. They're kind of like traditional government bonds, which have been a cornerstone of government finance for centuries. Countries issue bonds to raise money. Investors buy them because they're considered safe. The US pays interest. Eventually, the principal is repaid. But the US could issue bonds that are backed by or payable in Bitcoin. This is where it gets interesting. This could attract a whole new class of global investors who are super bullish on cryptocurrency. There are billions of dollars, maybe trillions, sitting in crypto-focused funds held by individuals and institutions that believe in the future of digital assets. These investors might not be interested in traditional dollar-denominated bonds, but Bitcoin bonds? That's a different story. By tapping into this fresh capital, this pool of money that's currently looking for crypto-related opportunities, the government could potentially borrow money at lower interest rates than it currently does. Lower interest rates mean lower borrowing costs. This could save taxpayers billions or even trillions in interest payments over time. Right now, the US pays hundreds of billions of dollars every year just in interest on the national debt. That's money that could go to infrastructure, education, defense, social programs. Instead, it's going to bondholders. If you can reduce that interest burden by offering bonds that appeal to crypto investors, you've found a significant source of savings. It's just a smart move that would leverage the global demand for Bitcoin to make government debt more manageable. You're essentially using innovation and market forces to reduce the cost of government borrowing. And let's not forget about the broader crypto ecosystem. There's more to this story than just Bitcoin. Take stablecoins, for instance. These are cryptocurrencies that are pegged to the value of a stable asset, like the US dollar, Tether, USDC, and others have become huge players in the crypto market. If we see an increased and regulated use of US dollar-backed stablecoins around the world, if these become the standard way that people move value in the digital economy, it could actually boost demand for US Treasury bonds. Why? Because the companies that issue these stablecoins need to back them up with real, safe assets. For every stablecoin they issue, they need to hold equivalent value in reserve. And US Treasuries are the go-to option. They're considered the safest asset in the world. They're liquid, they're stable, and they're backed by the full faith and credit of the United States government. More demand for treasuries means the government can borrow more easily and at a lower cost. When there are more buyers for your bonds, you don't have to offer as high an interest rate to attract them. It's a fascinating feedback loop where new digital technology could end up strengthening a traditional government financial instrument. It's not Bitcoin versus the dollar. It's not crypto versus traditional finance. In this scenario, they actually support each other. The growth of stablecoins creates more demand for the very treasury bonds the government needs to sell to finance its operations. Now let's be real. This isn't a simple, magic bullet solution. Nothing ever is when we read talking about trillions of dollars and the foundations of the global financial system. Integrating cryptocurrency into national fiscal policy is incredibly complex and comes with its own set of challenges. We need to be honest about that. First off, there's the volatility. Bitcoin's price can swing wildly, and I mean really wildly. We've seen days where Bitcoin drops 20%, weeks where it gains 50%. This kind of volatility makes it a risky asset for a government to rely on. Governments need stability. They need to know what their assets are worth so they can plan budgets, make commitments, and maintain confidence. A major price crash could have the opposite effect of what we want. Imagine the government puts billions into Bitcoin, the price crashes, and suddenly instead of reducing the debt, we've just created a massive loss on the national balance sheet. That's a political and economic nightmare. Then there are regulatory hurdles. Big ones. The legislative framework for crypto in the US is still being built. We don't have comprehensive laws that clearly define how cryptocurrencies should be treated, how they should be taxed, how they fit into securities regulations, what consumer protections should exist. Congress is working on it. Agencies are issuing guidance, but we're far from a settled legal landscape. Implementing any of these large-scale strategies, whether it's a strategic Bitcoin reserve or Bitcoin bonds, would require clear, comprehensive laws that currently don't exist. You can't just have the Treasury Department start buying Bitcoin without legal authority. You can't issue bonds denominated in a digital asset without a regulatory framework. So yeah, swift implementation is unlikely. This is going to take time, debate, careful planning, and probably a lot of political wrangling. Plus, increased adoption of a decentralized asset like Bitcoin could complicate things for the government in unexpected ways. How do you effectively manage fiscal policy and tax collection in an economy where a significant portion of wealth is held in a peer-to-peer digital currency, outside the traditional banking system? If people are holding and transacting in Bitcoin, if businesses are accepting it, if wealth is moving in ways that banks can't track, how does the IRS collect taxes? How does the Federal Reserve manage monetary policy? These are tough questions that economists and policymakers are grappling with right now. There aren't easy answers. Some people say better tracking technology will solve it. Others argue we need new types of regulations. Some think the system can adapt without major changes. There's a delicate balance to strike between embracing innovation, supporting new technologies that could benefit the economy, and maintaining financial control and stability, ensuring the government can still perform its basic functions. The relationship between cryptocurrency and national debt is evolving in real time, and it's a wild ride. We're watching this unfold as we speak. Despite these challenges, despite all the complications and unknowns, the potential upside is too significant to ignore. You can't just stick your head in the sand and pretend crypto doesn't exist. As Bitcoin's market grows, as more money flows into digital assets, as more institutions add crypto to their portfolios, the numbers become impossible to ignore. Some estimates suggest Bitcoin could represent nearly 18% of total global financial assets by mid-century. 18%. That's not a niche market. That's not a fringe investment. That's a major component of the global financial system. Its role in the global economy is set to become much more prominent, whether governments like it or not, whether traditional financial institutions are ready or not. For the US, ignoring this trend could mean missing out on a crucial opportunity. Other countries are already exploring crypto strategies. El Salvador made Bitcoin legal tender. Other nations are considering similar moves. China has banned crypto trading but is developing its own digital currency. The race is on, and the US needs to decide whether it's going to lead, follow, or sit on the sidelines. A strategic approach, one that's thoughtful and well-planned, could redefine how we manage debt and secure our economic future. It's all about being forward-thinking and preparing for a world where digital assets play a major role. This isn't science fiction. This is the world we're moving into, and the question is whether America will shape that future or just react to it. So, what's the bottom line here? The $37 trillion debt is a monumental challenge. It's one of the biggest economic issues facing our country. There are no easy answers, no quick fixes, no painless solutions. And gold will likely continue its traditional role as a safe haven, a reliable anchor in stormy economic seas. It's been around for thousands of years, and it's not going anywhere. But Bitcoin and the broader crypto ecosystem present a new, dynamic set of tools that could, if managed wisely, if implemented carefully, if approached with both optimism and caution, offer a path toward alleviating this massive debt burden. From creating strategic reserves, building up holdings while prices are still accessible, and issuing Bitcoin bonds that tap into a new investor base to leveraging stablecoins that create additional demand for US treasuries, the possibilities are both exciting and complex. Understanding these emerging fiscal strategies is crucial as our national debt continues to climb. This isn't just a theoretical discussion for academics and policy wonks. It's about the future of our economy, your economy, the financial world your kids are going to inherit. What do you think? Is leveraging Bitcoin a brilliant, forward-thinking strategy that could help solve one of our biggest challenges? Or is it a reckless gamble that could backfire spectacularly? I'd love to hear your thoughts in the comments below. Are you bullish on Bitcoin? Skeptical? Somewhere in between? And if you found this exploration interesting, if you learned something or it got you thinking about these issues in a new way, make sure to like this video and subscribe for more deep dives into the future of finance. Thanks for tuning in.